Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. In this video, I'm going to explain you about the provisions of clubbing of income, aggregation of income. Normally, a person is liable to pay tax on his own income, but sometimes an SSC is liable to pay tax not only on his own income, but also on the income of another person. That means the other person's income is also included in the income of the SSC, and SSC has to pay the tax. These are the special circumstances where the income of two persons will be clubbed together. The SSC is liable to pay tax on both the incomes, on his own income and on the income of other person. That is called clubbing of income. So in this video, I'm going to explain you what are the provisions regarding clubbing of incomes given under Income Tax Act under section 60 to 65. Last video, I have completed the problems on computation of tax liability. I have explained in detail and so many problems I have solved on computing the tax liability by applying the provisions of Income Tax Act for the current assessment year 21-22. So if you have not watched, go to the playlist of my channel, select the subject advanced aspect of income tax, watch the videos of computation of tax liability. And this video is entirely a different one, here clubbing provisions. So before explaining further, take a screenshot of the notes which I have written on the board so that you can make a copy and maintain it. You can remember the points and you can write in examination. Very frequently in examination, theory question will be asked regarding what are the provisions of clubbing of income. What are the provisions under section 60 to 65? Take a screenshot, then I'll explain all the points. So now, a person may transfer the assets for inadequate consideration, and the arrangement is made in such a way that the benefit of income is derived directly or indirectly by the transfer. Sometimes, a person will transfer the asset to another person without any consideration or inadequate consideration. In that case, directly or indirectly, the benefit will be derived by the transferor. Only for the sake of avoiding the tax, a person has transferred the asset or income to another person. The real beneficiary is the transferor. So Income Tax Act says whatever income is there on that asset which is transferred without any consideration, that income will be included in the income of the transferor. In the income of the transferor. In such a case, the transferor is liable to pay tax on the transferred asset. For example, Mr. X has transferred some property to Mr. Y. Both are brothers. X and Y are brothers. X is the elder brother, Y is the younger brother. X is a rich person. He has simply transferred the asset without any consideration to Mr. Y, or transferred the income without transferring the asset. He has not transferred the asset, only income he has transferred. In that case, whatever income Y has earned, that will be included in the hands in the computation of X transfer. And transferor is liable to pay the tax. Now, the provisions regarding such clubbing of income are contained in section 60 to 65 of the Income Tax Act 1961. So when the incomes are clubbed, integrated, those provisions are contained here. The following incomes of other persons are included in the total income of the SSC. Now I am explaining one by one what are the provisions given under section 60 to 65 of the Income Tax Act regarding clubbing. What are the cases, what are the circumstances in which clubbing will be done. First case, transfer of income without a transfer of asset. Transfer of income without the transfer of asset. One person has transferred the income to another person without transferring the asset. Example, Mr. X, Mr. Y, both are suppose brothers. X has transferred, X is the owner of a building. X is the owner of a building. He has let out the building to tenant. on the instruction that every month the rent should be paid to Mr. Y. Rent should be paid to Mr. Y. So presently Y is the receiver of the rent. He is getting the income. But Mr. X has not transferred the asset in the name of Y. Only the income is transferred in the name of Y. In that case, Income Tax Act says whatever income Y has earned, that income is included in the income of X. Because X have transferred only income, not the asset. In that case, the income earned by the transferee is included in the income of the transferor. This is a specific provision given by Income Tax Act. If a person transfers income generated from an asset without transferring the asset, then he is liable to pay tax on the transferred income. Second, revocable transfer of asset. Revoke means taken back. Revoke means taken back. For example, Mr. X has transferred some asset to Mr. Y on the condition that this asset will be reverted back. That means taken back by Mr. X after a certain period of time. So till that period of time, Y is the owner. After that specified period of time, again the asset will be reverted back to the transferor X. It is called revocable transfer. So if the transfer is revocable, then any income arising on that asset is taxable in the hands of the transferor. X is the transferor. X has transferred the asset to Mr. Y for a specified period of time. On the condition that after the expiry of the period, again the property will be reverted back, taken back by X. It is called revocable transfer. Then income arising on that transfer is taxable in the hands of the transferor. Next, income of a minor. If a minor earns income, the income of minor will be included in the income of the parent. In the income of the parent, whether mother or father, whichever parent has higher income, that parent's income, minor's income will be included. So Income Tax Act says we have to see which parent is having higher income. In that parent's income, minor's income will be included. That is the provision regarding income of minor child shall be clubbed with the income of his parent. The income of minor child will be included in the income of his father or mother, whose income is higher. The Income Tax Act says we have to check whose income is more, mother or father. Whichever parent is having more income, in that income, the child, the minor's income will be included. If the parent are not alive, then guardian of the minor is liable to pay tax. Suppose if there are no parents, no father, no mother. In that case, Income Tax Act says who is the guardian of the child. The income of the child will be included in the guardian's income. Guardian is liable to pay the tax. In the following situation, the provision of clubbing does not take place. That is, minor is ascertained as a separate individual. Two exceptions are given. In these two exceptions, clubbing provision will not apply. That means whatever income is earned by the minor himself will be assessed as an individual. What are the two circumstances? First, if a minor is having income or profession by rendering his personal skill or knowledge. Nowadays, many child artists are there. They will perform in advertisement. They will perform in movies. Then the income earned by applying their own skill, knowledge. If the minor child has earned the income by applying his skill or knowledge, specialized skill, then in that case, the income earned by the minor will not be included in the income of the parent. The minor will be charged, assessed separately as an individual. Secondly, if the minor is physically handicapped, as explained under section 80U, the minor is assessed separately. Second, if the minor is physically handicapped, in that case also clubbing provision will not apply. The minor child will be assessed separately. Then according to section 10, subsection 32, if the income of an individual includes the income of a minor child, then individual shall be allowed exemption, which is least of the following two amounts. Income Tax Act says if a person's income includes the income of a minor child. For example, father's income includes the income of minor son. In that case, father will get exemption under section 10, subsection 32. The exemption is least of the following two. Actual income of the minor child or 1500 per annum per child. Whichever is least will be allowed as exemption in the hands of the parent. Now, income of spouse. Sometimes an assessee will transfer the asset in the name of spouse without consideration or inadequate consideration. So whatever income earned by the spouse will be included in the income of the transferor. The transferor is liable to pay the tax. Example, Mr. X has purchased one property in the name of Mrs. X without any consideration. Mr. X purchased the property in the name of Mrs. X. So whatever income earned on that property by Mrs. X is included in the income of Mr. X because he has transferred the asset without any consideration or inadequate consideration. So income of the spouse. If any asset is transferred to the spouse, then the income from such asset is clubbed with the income of the assessee. The relationship of husband and wife should be there at the time of transfer of the asset. If husband and wife relationship is there, then only this provision will apply. If there is no husband and wife relationship at the time of transferring the asset, that means the provision will not apply. That means clubbing provision will not apply if husband and wife relationship is not there. Pin money. Any money given by the husband to wife to meet her personal expenses or domestic expense is known as pin money. So normally when the husband gives a fixed sum of money to the wife for meeting day-to-day domestic expenses, that is called the pin money. It's the separate property of the wife. That property will not be included in the income of the husband. The pin money will not be included in the income of the husband. Next, asset transfer to spouse or minor child. Sometimes an assessee will transfer the asset for inadequate consideration or without any consideration either to spouse or to minor child. For example, Mr. X purchased a house not in his name but in the name of a minor child. Then whatever income earned in the name of minor child will be included in the income of the parent, in the income of the transferor. Then transfer of assets to daughter-in-law and grandchild. Still, one more provision is given by the Income Tax Act. If an asset is transferred to daughter-in-law or grandchild, then the income earned by daughter-in-law or grandchild will be included in the income of the transferor. The next comes transfer of property by any member of HUF, Hindu Undivided Family. The members of the Hindu Undivided Family are called co-partners. Suppose if the co-partner or member of HUF has purchased a property and transferred the property in the family property, in the HUF property, that means whatever income earned from that property will be included in the income of the member. The income will not be taxable in the hands of HUF. The income is taxable in the hands of the member who transferred the asset to HUF. Next one, Benami transaction. If a transaction is there only on the piece of paper, but real benefit directly or indirectly is enjoyed by the transferor, in that case, the income earned from that transaction, Benami transaction, is taxable in the hands of the transferor. For example, Mr. X has purchased a property in the name of his employee, but all the income of that property is earned by Mr. X only. Only for the sake of avoiding the tax, he has purchased the property in the name of another person. It is called Benami transaction, not a genuine transaction. To avoid the tax, to reduce his tax liability, he has purchased the asset on the piece of paper. He has purchased the asset in another person. So Income Tax Act say, see who is the genuine beneficiary of the transaction. The transferor is liable to pay the tax. Next, cross gifts. Two or more transactions which are interconnected and are part of a single transaction. Two or more transactions are there which are interconnected and a part of a single transaction in order to avoid the tax. In order to avoid the tax. Actually, only one transaction is there, but for the purpose of avoiding the tax, two interconnected transactions are conducted. Those two transactions are called cross gifts. Example, Mr. X and Mr. Y. Mr. X gives a gift of 12 lakh rupees to Mr. Y, and Mr. Y has given a gift of 10 lakh rupees to Mr. X. Both have given gift to one another. It's a cross gift. Any income earned, for example, both have deposited the money in the bank at 10% rate of interest. So Mr. X has deposited 12 lakh, Mr. Y has deposited 10 lakh. Both have exchanged. In that case, what is the matching amount? 10 lakh. The matching amount is 10 lakh. Suppose if 10% is the rate of interest, 10% of 10 lakh, 1 lakh rupees is the income. So 1 lakh rupees income is included in the income of X and also in the income of Y, because they have conducted cross gift. Then last one is income from partnership firm. According to the provisions of Income Tax Act, the profit earned by a partner from partnership firm is exempted, is not taxable, because partnership itself will be treated as an individual, as a person. Partnership firm is treated as a person and partnership firm is liable to pay tax. Presently the tax rate is 30%. So apart from profit, when the partner is getting salary or commission or remuneration, all these things are taxable in the hands of the partner, but profit received from the partnership firm is not taxable. That's it. So these are the provisions you have to remember regarding clubbing or aggregation of income. In the next video, I'll start one or two problems are enough for this clubbing or integration of income. But before concluding this video, I want to inform you that I have started a new channel by name Khan's Accounting Institute. This is the channel name, Khan's Accounting Institute. This channel I have made for IGCSE students. So those students, viewers who are pursuing IGCSE course, that channel is very, very beneficial. And generally it is beneficial to everyone. Whoever wants to increase their knowledge, they can watch that video. Khan's Accounting Institute. Please do visit the channel, watch the videos, enhance the knowledge, and do subscribe that channel also. Inshallah, we'll take up the problems on clubbing of income in the next video.